Gold prices are climbing toward the 1 lakh per 10 grams milestone, and the speed of the surge has dominated every financial headline. This momentum triggers a specific psychological response: the fear of missing out. Retail investors often enter the market at these peaks, buying into the trend without looking at the underlying mechanics driving price. Allocating capital based on a headline is a high-stakes gamble. Without analyzing the specific data points behind the movement, you are essentially operating in the dark. Following the crowd increases your exposure to a sudden correction. Navigating this market requires moving past the hype and looking at the actual numbers. Gold's recent price movement follows a distinct set of economic variables. By mapping these trends, we can see the trajectory of the current surge. This scatterplot shows how daily price fluctuations can look chaotic. However, once we isolate the gaps between historical records and recent performance, a clear upward trend emerges from the noise. Relying on data-driven patterns helps strip away the emotional bias of a fast-moving market, revealing where the demand is actually originating. Assessing the probability of gold hitting 1 lakh requires a shift in perspective, moving from speculative guessing to rigorous data analysis. The first variable is global uncertainty. Geopolitical tensions historically trigger a specific reaction in institutional behavior. During periods of instability, large funds often exit traditional equities, seeking a more stable store of value to protect their holdings. This capital frequently moves into physical reserves. Central banks across the globe are currently stockpiling gold at a significant rate. This institutional buying occurs at a scale that far exceeds the impact of individual retail investors, removing vast amounts of physical supply from the global market. Persistent demand from central banks creates a solid price floor. As supply is locked away in vaults, the global price faces constant upward pressure. The third variable is the devaluation gap. This measures the distance between the rising cost of goods and the eroding purchasing power of your currency. Inflation naturally diminishes what a single unit of currency can buy over time. As the cost of living increases, the relative value of fiat cash decreases. This chart shows gold acts as a financial stabilizer. When paper currency value trends downward, gold price typically moves in the opposite direction. Data from the last few days shows this inverse correlation accelerating, reflecting a global shift in currency strength. The numerical price of gold increases as the currency used to buy it becomes weaker. In this context, gold maintains its value while the cash around it loses ground. The final variable is the cultural multiplier, a domestic cycle that acts as a consistent catalyst for demand within India. Wedding and festival seasons create a predictable spike in demand. This requirement for physical gold is often independent of global economic conditions. Even during price surges, domestic buyers continue to purchase gold for cultural reasons, ensuring a steady stream of retail demand regardless of the market peak. When this localized, inelastic demand layers on top of global institutional buying and inflation, it creates a powerful combination of factors driving the price higher. Combining these 4 data points, geopolitical panic, sovereign hoarding, currency devaluation, and cultural demand, shows they are all currently moving in the same direction. If these specific macroeconomic trends maintain their current trajectory, the 1 lakh milestone becomes a statistical probability. The current surge reflects a simultaneous alignment of these 4 variables, providing a clear explanation for the recent price action. However, historical data and current trends cannot account for unexpected market shocks. No analysis offers a complete guarantee against sudden volatility. Maintaining strict risk management is essential. Always understand your personal financial limits before entering a market with this much momentum. Use this framework to inform your own logic. Every investment decision should be based on your own analysis of the risks involved. We want to hear your perspective on the market. Share your own analysis and data points in the comments below. Success in any market depends on consistent risk management rather than chasing a single outcome. See you in the next breakdown.